Welcome to today's deep dive into one of the most essential investing strategies, defensive investing. If you're looking for a strategy that helps you preserve your capital, avoid speculation, and invest in stable, long-term assets, then you're in the right place today. We'll be focusing on Benjamin Graham's approach to defensive investing as outlined in his classic book, The Intelligent Investor. This philosophy is designed to minimize risks while providing steady, consistent returns over time, while growth investing may grab the headlines. Defensive investing is about protecting your hard-earned money by avoiding risky bets and focusing on conservative, stable investments. Why defensive investing matters. Investing is not just about making money, it's also about protecting the capital you've already accumulated. Defensive investing is about maintaining your wealth, reducing volatility, and avoiding the emotional roller coaster of market speculation. Graham's principles are designed for investors who don't have the time, resources, or appetite for high-risk speculation, but still want to generate decent returns over the long term. We'll break down the key concepts of defensive investing and provide actionable tips you can apply right away. We'll also explore examples and real-world strategies for implementing these principles. Understanding defensive investing. What is defensive investing? At its core, defensive investing is about investing in assets that have a strong track record of stability, low volatility, and consistent performance. These assets are typically less susceptible to market fluctuations and economic downturns. Graham's definition of defensive investing is focused on the idea that preserving capital is more important than chasing speculative returns. The goal is to achieve an adequate return while reducing the risk of significant loss. Key characteristics of defensive investments include reliability, consistency, and a low-risk profile. They may not offer massive returns, but they can provide peace of mind, knowing that your capital is protected. The philosophy behind defensive investing in The Intelligent Investor. Graham categorizes investors into two types: defensive investors and enterprising investors. Defensive investors focus on minimizing risks and making safe, predictable investments. Enterprising investors, on the other hand, are willing to take on more risk for higher potential returns. Graham stressed that defensive investing is for those who wish to avoid market speculation and focus on the long-term preservation of wealth. The defensive investor is not trying to time the market or pick individual stocks, but rather follows a set of guidelines designed to create a balanced portfolio that can weather economic storms. Key principles of defensive investing. Diversification. Diversifying your investments across a range of stable, low-risk assets is a cornerstone of defensive investing. This helps to spread risk and reduces the impact of market fluctuations on your overall portfolio, emphasizing quality over quantity. When selecting investments, it's important to focus on quality, well-established companies with solid earnings, strong management, and consistent dividends. Avoiding speculation. Speculation involves betting on stocks or assets that are prone to extreme volatility or that have an uncertain future. Defensive investing avoids this by sticking to stable investments, even if the growth potential is limited. Long-term focus. Defensive investing requires a long-term outlook. Instead of reacting to market noise, you focus on the overall health and stability of the companies or assets you've invested in. Building a defensive portfolio. The role of bonds in defensive investing. Bonds are a key element of a defensive portfolio. They offer predictable returns and are generally less volatile than stocks. By including high-quality government and corporate bonds in your portfolio, you can reduce the overall risk. Discuss the different types of bonds. Government bonds, safe, stable, and low-yielding, but provide a solid foundation. Corporate bonds, high yields but slightly more risk. Focus on investment-grade bonds from well-established companies. For defensive investors, the goal is not to seek high yields but to maintain stability and ensure that your portfolio generates consistent income without significant risk. The role of dividend stocks. Dividend-paying stocks are another excellent choice for defensive investors. These companies tend to be well-established, with stable earnings and a commitment to returning value to shareholders. Discuss the importance of selecting blue-chip stocks, such as those from companies with a long history of consistent performance. For example, Coca-Cola, Johnson & Johnson, Procter & Gamble, Explain how dividends provide a steady income stream, helping to buffer against market volatility. Real estate as a defensive asset. Real estate is a tangible asset that offers long-term growth potential while also providing income through rental yields. By including real estate investment trusts, REITs, or physical property in a defensive portfolio, you add a layer of protection against inflation and market fluctuations. REITs can offer defensive investors exposure to real estate with less capital investment and lower risk compared to owning physical property. The importance of cash and cash equivalents. Maintaining cash or cash equivalents, such as money market funds, is an important part of a defensive strategy. Having liquid assets allows you to take advantage of opportunities when they arise and provides a cushion in case of market downturns. While cash may not generate high returns, it ensures that you have the flexibility to act when needed without having to sell investments at a loss. Analyzing risk and avoiding speculation. Understanding risk in defensive investing. Defensive investors aim to minimize risk, but it's important to understand that no investment is risk-free. The key is to focus on low-risk investments that align with your long-term goals. Discuss various types of risk: market risk, inflation risk, and credit risk. By diversifying your portfolio, you can spread risk and ensure that no single investment has the potential to derail your financial plan. The dangers of speculation. Speculative investments are those that rely on price fluctuations or market sentiment, rather than on the underlying fundamentals of a company or asset. These investments can be highly profitable in the short term but come with a much higher level of risk. Discuss the difference between investing and speculating. Investing involves buying assets that are expected to provide returns based on their intrinsic value, while speculation is more about betting on price movements without regard for the asset's true value. Use examples from the dot-com bubble, the housing crisis, and cryptocurrency speculation to highlight the dangers of speculation. Behavioral pitfalls in defensive investing. One of the biggest risks for defensive investors is falling into emotional traps during market downturns. It's easy to panic and sell when the market falls, but Graham's philosophy stresses the importance of staying the course. Discuss the herding behavior and how investors often follow the crowd, which can lead them to make poor decisions. By focusing on long-term, stable investments and avoiding market hype, you'll be able to withstand market fluctuations and remain focused on your capital preservation goals. Case studies and real-world applications. Case Study 1. Warren Buffett's defensive investing strategy. Warren Buffett, one of Graham's most famous disciples, is known for his defensive investing style. He emphasizes investing in companies with a strong competitive advantage, a predictable earnings stream, and a track record of stability. Walk through Buffett's investment in Coca-Cola and how it exemplifies defensive investing principles. Case Study 2. The financial crisis of 2008. The 2008 financial crisis provides a perfect example of the importance of defensive investing. Many investors who were heavily invested in risky assets, such as subprime mortgages and leveraged stocks, suffered massive losses. Discuss how defensive investors who focused on bonds and blue-chip stocks were better positioned to weather the storm. Case Study 3. The COVID-19 pandemic and its impact on markets. The COVID-19 pandemic triggered one of the most dramatic market crashes in history. Defensive investors who held cash, bonds, and dividend stocks were able to withstand the volatility, while those who were overly exposed to speculative assets saw significant losses. Discuss how the pandemic emphasized the importance of having a defensive investment strategy. Creating your own defensive portfolio. Defining your goals and risk tolerance. Before you build a defensive portfolio, you need to define your goals. Are you saving for retirement? Do you need income now, or are you building wealth over the long term? Understanding your risk tolerance is critical in deciding the types of investments to include in your portfolio. Asset allocation for defensive investors. The key to a successful defensive portfolio is finding the right mix of assets. Let's look at how you can allocate your portfolio across bonds, stocks, real estate, and cash. Discuss different models of asset allocation, such as the 60-40 split: 60% stocks, 40% bonds, and more conservative allocations. Maintaining and rebalancing your portfolio. Defensive investing is not a set-it-and-forget-it strategy. You must regularly monitor and rebalance your portfolio to ensure it stays aligned with your goals. Explain how to assess whether an asset's risk profile has changed and how to rebalance accordingly. Regular review and adjustment every few years. It's important to review your portfolio and adjust your asset allocation based on any changes in your life or financial situation. Conclusion: defensive investing is about protecting your capital, avoiding speculation, and focusing on stable, reliable investments. By diversifying your portfolio, focusing on high-quality assets, and avoiding the emotional traps of market speculation, you can weather any storm. Remember, defensive investing is not about seeking high returns, it's about steady growth and capital preservation over time, encouraging continued learning. Thank you for joining me today. I hope you found these insights into defensive investing helpful. If you're ready to put these principles into practice, start by reviewing your own portfolio and assessing how much risk you're willing to take. Stay disciplined, be patient, and always remember that protecting your capital is just as important as seeking returns. Recap of key takeaways. We've covered a lot today on defensive investing, from understanding the importance of protecting your capital to exploring the strategies that can help you build a stable and low-risk portfolio. By focusing on assets that are reliable and less prone to market volatility, we've learned how to preserve wealth while still achieving steady, long-term growth. Remember, defensive investing isn't about high returns or chasing after market trends. It's about taking a more cautious approach and ensuring your investments are resilient in any market condition. Call to action. If you found today's video valuable and learned something new, don't forget to hit the like button. It helps the video get discovered by others who are looking for the same insights. I'd love to hear from you. Are you currently using defensive investing strategies in your portfolio? Or do you have any questions about how to apply these principles? Drop your thoughts in the comments below. I always enjoy engaging with you and answering your questions. And if you're new to the channel, make sure to subscribe and turn on notifications so you never miss future videos on investing strategies, portfolio management, and financial tips that will help you grow and protect your wealth. Teasing future content in the next video, we'll dive into the enterprising investing strategy, which is focused on finding opportunities for higher returns. So make sure to stay tuned if you want to learn about more active approaches to investing. We'll also be talking about asset allocation and how to create a diversified portfolio that balances both defensive and growth-oriented investments. Thank you for watching and being part of this community. I truly appreciate your time and commitment to learning about sound investment strategies. Keep applying these defensive investing principles, stay disciplined, and remember, protecting your capital is key to achieving long-term financial success. I'll see you in the next video. Stay safe, invest wisely, and take care.